Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. We'll news the disconnect between equity market sentiment and economic data seems to be getting wider. But first, we get the American labour market report for May on Saturday, and today the precursor ADP employment report was released. It reported 2.8 million jobs were lost in May, vastly less than the expected 9 million, and vastly less than the April 20 million. Analysts are expecting the American non-farm payroll report to show job losses of 8 million, but this could be at the top end. The giant American services sector contracted sharply again in May, but not quite as sharply as for April. New order levels are still shrinking, but again not quite as dramatically as in the previous month. The ISM report wasn't as sharply negative as expected, but the internationally benchmarked market one was. But essentially they both tell the same story of building service sector contraction. On the manufacturing front, the official factory order data for May shows a worse situation than for April. But the less than expected jobless signals and the less than expected signals for PMI falls is being magically translated into positive signals on Wall Street. Equity markets have priced in a full recovery as though the pandemic is over and the fleeting historical bump in the road. Interestingly, China has said it was considering applying to join the Trans-Pacific Partnership. It would be a powerful boost to the trade group that the US rejected. But it would require China to sign up to much higher labour and environmental standards than their watered-down RCEP group permits. The Chinese comments drew immediate scepticism about the motives. And China's private sector services PMI review has reported a rather remarkable improvement in May, far better than the official version. It now sees China's service sector expanding at its fastest clip in more than a year. But quite the opposite is going on in India, which reported another very grim service sector PMI as their country remains in lockdown. And the Aussies reported the first quarter 2020 GDP yesterday, and it was down 0.3% in the quarter. Their government says the second quarter 2020 will be much worse, so we're in recession today, they say. It's Australia's first recession in almost 30 years. One reason analysts are almost certain the second quarter will be weak can be seen in their May services PMI, which is still contracting at a very sharp rate. US Treasury 10-year yield is up sharply today, up 8 basis points to 0.76%. The gold price is lower again today, down $25 to just on $1,700 an ounce. US oil prices are unchanged today. US crude price is still just over $36.50 a barrel, and the Brent price is just on $39.50 a barrel. And the Kiwi dollar is still rising, and we're now just on 64.3 US cents, which is another 0.75 cent gain, and now a 15-week high. On the cross rates, we're up 0.5 cent to 92.7 Australian cents. Against the euro, we're also firmer at 57.2 euro cents. That means our trade-weighted index is now just on 69.1. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.